decision, they are using the word whether due to be settled within 12 months. Accordingly, if you are asking me a trade payable, if it is outstanding for 3 years, whether it will be non-current liability, definitely will not be non-current liability, because according to the terms of your purchase, it may be 90 days credit. So it is due to be settled. But for some reason you are keeping it not settled, maybe because of your negotiation or some other reason, or maybe a poor quality which has been delivered. So to that extent, it will continue to be a current liability. That is the reason why if you are saying revised Schedule 6 as well as Schedule 3, trade payables is not at all coming in any of the non-current area. That is one thing. One problem which I have seen with respect to current assets and current liability, especially on current liability, on the fourth point, whether the company does not have an unconditional right to defer settlement. I will take one example. A company has taken a loan, which is a term loan, repayable on 60 monthly installment, 5-year term loan. So it is a long-term liability. So when I am saying non-current liability, my current ratio will not have any implications on that, except what is due to be settled within the next 12 months. 1-year repayment period, 12 months installment will be classified as a current liability, and accordingly to that extent it will have an implications on current ratio. Balance 4-year repayment will be a non-current portion, so that non-current portion will not have any issue on this. But the issue which I am seeing is, if there is a default on the loan settlement, there is a covenant breach, and the covenant breach in the loan agreement, it says that the banker or the financial institution which has given, or the lender has given that loan, has a right to recall the loan, that is, or making the loan as repayable on demand, whether that loan will become a current liability or a non-current liability. My problem starts with one simple question: whether the guidance issued by the Institute of Chartered Accountants of India on the revised Schedule 6 will hold good for Schedule 3 of the Companies Act 2013 also, because in revised Schedule 6 guidance note, the institute has taken a position that in Indian law, there is no circumstances where the banker has recalls the loan or making it as repayable on demand, and accordingly, still, unless the banker has recalled and the recall notice has been issued before the close of the accounting period, then that loan will continue to be a term loan, non-current liability. Whereas if you literally go by the definition of Schedule 3, as soon as a covenant breach is there and there is a unconditional right to defer settlement is not available, it becomes a current liability. So we have to wait and watch whether the MCA will still agree with the guidance note on revised Schedule 6 will be squarely applicable to Schedule 3 also. Because my only worry was where they are talking about Ind AS is not giving this option, because IFRS is not giving this option, Ind AS is not giving this option. In both the cases, it's a rule-based condition. If there is a default, repayable on demand condition is already there, it becomes a current liability. It will have an enormous hardship on many companies, one issue. Intention of the management is important, expected to be realized. Management will say that I am expecting to realize within the next 12 months. But they are continuing to say the same statement year on year. So expectation is okay. Management's intention is also understood, but it should be demonstrated. So accordingly, auditors may ask a lot of questions to demonstrate. Current and non-current should be tested from the angle of the preparer. For example, I have taken one case where I am talking about a loan given by a parent company to the subsidiary company. How the subsidiary company and parent company has to deal with that. Suppose if it is repayable on demand. When I am classifying this loan from the angle of the subsidiary company, because it's repayable on demand, I have to classify as a current liability. Whereas from the parent company's angle, parent company has given this loan and never called this. So is an asset decision making where whether expected to be realized, whether I am going to really call for that within the next 12 months. If I am not going to call for that, if my intention is not to call for that, in that case, again, this is not a current asset in respect of the parent company, but it will be a non-current asset in respect of the parent company. So you have to see from the angle of the preparer to assess this. Consolidated financial statement will be mandatory for all companies which are having one or more subsidiary. The term subsidiary, as I have pointed out, will include associates and joint ventures, and accordingly, every company having an associate or joint venture should also prepare the financial statement in a consolidated pattern. And the next problem which is coming in, they are prescribing how the format and content of the consolidated financial statement should be. If they have only talked about the form, I don't have a problem. When they have used the word form and manner similar to standalone financial statement, what happens is, if there is a requirement of disclosure for the standalone financial statement, for example, licensed capacity, if you are talking about your consumption percentage, indigenous, managerial remuneration, calculations, etc., whatever you are talking about, which is applicable for under the revised schedule 6, that will applicable even on the consolidated financial statement. Whereas now, in the consolidated financial statement, we are avoiding certain disclosures which is not required as per accounting standard 21. That exemption will not be available because of the use of form and manner similar to standalone financial statement. I don't want to waste too much of time on this flow chart. I will only take the bottom of this, which is the sum and substance of the flow chart. The move to define what is a subsidiary is actually coming from the shareholding pattern and control. There are two issues which is coming in. One is, what is the voting power which the company is having on the subsidiary, and the change which has happened was they have used the word total share capital. So total share capital includes preference share capital also. That is a real problem now. And the second one is, when they are using the word control is the basis to decide whether it's a subsidiary or not. I will share you one simple example. We have took up a case study. One company was having 27 associate entities and 3 subsidiaries, 1 joint venture. For the purpose of assessing the total share capital basis as well as the control basis, what is the definition of a new subsidiary? Whether the 27 associates will continue to be an associate or they will move to a different perspective. To our surprise, out of 27 associates, 24 become a subsidiary company according to Companies Act 2013. So when it becomes a subsidiary, you will know that you have to be consolidated on line by line consolidation, which poses more challenges. And how you will get that financial information from the other company where you have invested less than the prescribed percentage, whether you are able to have a control on getting that information also, it's a challenge. That is one thing. So new holding and subsidiary relationship will come on that. I'm just making a small example which I was talking about. Equity capital is 100, preference shares is 200, out of which in case A, company A 100 has been invested and case B 30 has been invested, case A I have not invested anything. The same way, if you analyze under the existing Companies Act or the accounting standards, because the existing Companies Act refers to accounting standards rules 2006. In the first case, it is a subsidiary because I am holding more than 67% of the paid up capital, which is nothing but my equity capital. In the second case, even though I am holding equity shares of only 30%, the paid up share capital is total share capital, 100% of equity I am having, so I am having a control according to the accounting standard, so it is a subsidiary. Second case, I have only 30%, so I have significant influence and not control, and accordingly it is a subsidiary. And in a third case is a zero equity holding I have, and accordingly I don't have a subsidiary, I don't have an associate, I don't have a joint venture, so I will not consolidate. But under the Companies Act, if you take this position, in all the cases it becomes a subsidiary, even with the preference share capital. This is one big challenge when it comes to consolidated financial statement. Okay, accounting standard exemptions not available. Exemptions available for certain types of subsidiary. For example, subsidiary is acquired for a short-term investment. Whether there is an exemption is available. Accounting standard gives the exemption, but you don't have an exemption under the Companies Act 2013. What is given for certain non-performing subsidiaries, associates and joint ventures are not available. If the subsidiary or associate or joint venture is having a different accounting period, we have a possibility of having a financial statement prepared under a different accounting year and adjusting for the significant events, but may not be possible with respect to a subsidiary, because the subsidiary will automatically prepare the financial statement according to an Indian parent company, because Indian parent company has to prepare under 31st March rule. So accordingly, its subsidiary should also be preparing under 31st March rule, because it cannot get the exemption from the tribunal. Associate and joint ventures, there is a possibility. Present exemptions on disclosures can still be applied? No. When the act is notified, act will be having an upper hand than accounting standard rules, so you will be having more disclosures to be brought in. The important point, where I will take 5 minutes of your time, on the depreciation side. Useful economic life has been prescribed. So you can say that what is the minimum depreciation a company has to charge according to the Companies Act 2013 is as per Schedule 2. Schedule 14 of the existing Companies Act is really a minimum depreciation, because it says only, for example, it talks about a company can go to have an extended period. If I am applying the principle of the straight line method, a plant and machinery can be depreciated for 21 years. Whereas here they moved from the concept of minimum depreciation, but tried to fix up what is the minimum economic useful life you should consider. How they have arrived at this number, I don't have an explanation, because some of the audience who are sitting here are from industries who are having continuous processing machinery in their plant and equipment category. For them, the impact is significant. I should use the word significant, quoted, underlined, because it has so much of implications on that. I will show you with some example on that. The second is, suppose, is there any exemption from applying from Schedule 2? For example, if it is an electricity holding company or power generation company, they are coming under a regulatory authority. The regulatory authority is prescribing the depreciation rules. Only in that case they have been exempted from using it. One more exemption which they have given is, suppose if you are following Ind AS when it is notified, and it's a different set of accounting standards. That's what the Companies Act 2013 is trying to explain. In those cases, if you are using a different economic useful life other than Schedule 2 or less than what is prescribed in Schedule 2, you are permitted. But they are saying, what is the reason for adopting a lesser, extended economic useful life than what is given in Schedule 2 has to be defined, disclosed in the notes on accounts. This is the two possibilities. The third problem which is coming by means of Companies Act 2013 for depreciation accounting is component cost approach. If you, I will give an example. If you have the building, and if in the building you have a lot of items installed, for example, you have a lift, depreciation has to be considered for lift separately and building separately. So you will immediately say that is the way in which we normally do. Okay, I take another example. I have a furnace as my machinery, which is an important furnace for my usage, and most of my manufacturing process requires that furnace. In the furnace, the internal liners has to be replaced once in 3 years or 4 years, otherwise the heat withstanding capacity may not be there. But the other equipments will continue to be having an economic useful life of 20 years or 21 years as the case may be. Now, under the existing rule, under the existing depreciation principles, accounting standards as well as Companies Act 1956, we take the entire furnace as a single plant and machinery, single machinery. So 21 years we depreciate. If I apply 4.75%, that is also fine, because the straight line method for a single ship, that is also fine. Now, the new act says, if there is a significant component which has a different economic useful life, the different economic useful life for that component has to be applied separately for arriving at the depreciation. So your liners which you will be replacing once in 5 years has to be treated as a separate component of your furnace, which will be depreciated over 5 years period, and the other balance part will be depreciated over 21 years period. What would be the implication with the component cost approach? Coupled with the component cost approach, I have one more problem. This is a very simple logic. No provision for less than 5,000. You can practically come out of this exemptions, this rule, by saying any item which is purchased for less than 5,000 rupees, my economic useful life is considered as 1 year. So schedule 2 is having some other year, but I am considering 1 year. So I make an assessment which is lower than what is prescribed in schedule 2, still I will be in compliance. So that is left to the company, so that is not a big problem. But I take an example of the component cost